Tyler, we've made some videos about Dollar General over the past year or so. We did one recently, really taking a closer look at the challenges that former, now again, current CEO Todd Vasos has had to deal with in trying to turn the business back around. A ton of struggles over the past year and a half or so. And until there's more clear signs that the turnaround is working, investors should probably look elsewhere. We decided to make a video today with a couple of retail stocks that we think will do better.
You let me do my favorite thing, Jason, which is reach deep into my bag of or Rolodex of stocks, whatever you want to call it, and find a little gem. And I think I got one. I think you got one. I think this is going to be good.
Let's get to it. I'm Jason Hall. This is Investing Unscripted. That's Tyler Crow with me. This video is sponsored by The Motley Fool. We've got two great stocks we're going to talk about here, but if you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. That way you can get access to The Motley Fool's 10 best stocks to buy right now. Go check out that link. You can do it now. We'll wait for you. That means you just press pause. Or you can do it after you watch the video, whenever you decide to do it, but it's worth taking the time to check it out. Okay, Tyler, I don't want to belabor the point too much here with Dollar General. We did a video, I think it was just a week or so ago. It's easy to find on our channel, our YouTube channel, if you want to go back and do a little bit more of a deep dive. But really what I want to share is just a chart. So this chart looks at the past year, which is when Todd Vasos came back to Dollar General. So again, Todd Vasos was the CEO that led the company for many years through the bulk of its kind of growth phase, where it was really rapidly expanding. The results were great. Profits were growing. Cash flow was growing. Vasos stepped down, retired, and the business kind of ran into some real challenges where the growth strategy wasn't working anymore, some challenges with older stores, merchandising issues, challenges that its target customer was facing. And it's come back to roost where they're not turning over inventory as quickly. Margins are down. Staffing is a challenge. Inventory shrink is a growing challenge. And this is the past year. So Todd Vasos came back mid-October of 2023. So we're almost to the 1 year mark. I've got this chart here set to the quarter that started basically about the time that he came back. And we see a couple things. The purple line is the stock price. So again, right here, this is the most recent earnings report. You can tell market was not very happy after some initial optimism that Vasos was going to be the wizard to bring the magic back to Dollar General. And what have we seen in the business? Revenue's basically been flat. You think about with inflation, that revenue is actually that you're selling less goods or a worse mix of goods if your revenue is only up 1%. Plus, you've opened a bunch of stores, right? So comps have been negative. And as a result, earnings are down 25%. And the stock's down about 29%. So a lot of investors say, you know what? There's a value opportunity, maybe a turnaround opportunity. Yeah, we think maybe that's true. But instead of trying to buy the troubled discount retailer at a discount price, we have some really high performing retailers. One's a discount retailer. One is built to help people save money in the auto industry. Let's start with yours, Tyler.
I went with AutoZone, ticker's AZO. I think we both landed on the idea of like resilient retailers, recession resilient, because those are places that are going to still see floor traffic in a lower economic times. But the same can be said for automotive retailing with AutoZone and many of the other ones like that. And I think that's the reason I landed on this one, was that automotive retail tends to be a very, very resilient business through the ups and downs of the economic cycle.
Yeah, I don't want to say it's counter-cyclical, but people do tend to spend more on maintenance and car repairs and DIY work versus replacing a car when times are a little bit tougher, right? So these businesses certainly do quite well when times are a little tougher.
The thing about AutoZone in particular, and maybe the same could be said for O'Reilly Automotive. They both kind of land in this bucket, but they're both relatively high margin businesses for retailers, as well as just very, very good operators at what they do. Obviously, when you are running an automotive parts retailer, you have to have a lot of shelf keeping units or SKUs because so many unique parts for unique vehicles and whatnot. It tends to be having the right part at the right time can be challenging, but being able to do that well, you can make a lot of money. And that's been AutoZone's case. Over the past 10 years, their inventory turnover has been about 1.5 times. And that's like, you can set your watch to this happening.
Just for clarification, that means that they turn over their store's inventory one and a half
times every year.
Every year, right.
Yeah. But what's also equally impressive with them is they have is a thing called the cash conversion cycle. It's basically like how long until the money comes in the door to pay for all your accounts
Money out
receivables and things
versus
like
money
that.
in.
The longer the cash conversion cycle, the more you build up inventory. But AutoZone actually has a negative one, which means that it can like delay, put off paying its vendors before it actually gets the money coming in the door. It's kind of a
Yeah.
nice virtuous cycle. And it's just a sign of a very, very good operator who knows what to do and is very good at maintaining inventory and keeping things moving out the door at any given time. And then from a stock performance perspective, revenue is not going to be ever high growth, but it tends to make up for that because modest store growth and a lot of its free cash flow goes to buying back stocks. This has been one of those kind of what we want to call it cannibals, where it just basically buys back as much shares outstanding as possible. As a result, has been a fantastic performer over the past 10 years. It's had a total return of 520% for, again, a boring auto retailer. Doesn't necessarily sound like a market crushing business, but it has been. And I think that's likely to continue. I'm sure there's a lot of people that would say, "Oh, but with electric vehicles coming, there's so many fewer parts." That's partially true, but a lot of the parts that are common for automotive retailing, headlights, windshield wipers, suspension, a lot of the things that those are common across any
Right.
vehicle regardless of EVs. I think this is gonna be a durable business regardless of what happens in the automotive industry, and one that, I think if we're looking for something that's gonna beat Dollar General, I think this is kind of a layup.
Yeah, and I think you think about valuation too. It trades for not much over 20 times earnings, which for the business of this quality is reasonable. It's not cheap by any means, but again, you're paying a little bit of a premium for a business that's earned a premium, and that's one of the reasons it trades for that. So I think that's a good starting
And
point, Tyler.
and considering the cost for quality in the stock market today, that is a very reasonable cost for quality.
Yeah, no, exactly right. Okay, I've got one I'm going to talk about, and we're going to stick with kind of the idea of the discount retailer. We're talking about TJX companies. This is the owner of TJ Maxx and other what they call off-price apparel and home fashion. So discount retailer. Their big business, what they're really good at is they're good buyers. They are really good at buying excess inventory from distributors, wholesalers, and other retailers that are trying to, they don't want to put discount goods in their store. They want to sell it cheaply out the back door, not out the front door, because they don't want to dilute their brand. So this is a real company that's really good at acquiring that merchandise in bulk, getting it quickly into its stores and turning it over very quickly. It has been a wonderful long-term winner. And unlike Dollar General, and Dollar General's not alone, Dollar Tree and the Family Dollar, the Dollar, those are the same company, are also struggling. It's a demographic challenge on top of a challenge with the operation of those retailers. The TJX companies stores continue to do incredibly well. Profit margins are increasing, comps growing 4%. So more customers coming into the store, customers are spending more. Earnings were up 13% in the most recent quarter. So it's a business that is delivering. It is consistently delivering. I'm going to switch over to another tab here. The one challenge I want to say with TJX right now is that it's not cheap. I would say it's expensive. 28 times earnings is probably a little rich. So I don't know that I would necessarily be buying TJX companies at these prices, but I still, even with that higher premium, I think it's going to be a better performing stock over the long term than Dollar General, because Dollar General's business is still struggling. And we haven't seen clear signals that, even though it's deeply discounted, we haven't seen clear signals that the business is fixed its formula and is executing on delivering that formula. So that's the biggest challenge that I see with Dollar General. And I think the better business wins over the long term, even if the valuation might be a little bit on the rich end.